Decode smart money, the secret signals behind market moves. Margin, proprietary, foreign room. Introduction. What are foreign investors buying? How insiders spot the money flow before it happens. Have you ever wondered, why do some stocks suddenly surge dozens of %, even when the overall market is flat? Why do retail investors buy and instantly lose, while someone always gets in early and exits right on time? And here's the most important question. Where is the smart money, especially from foreign investors, really flowing? Welcome to Bold Steps Forward, where we don't just talk about the market, we learn to track money flow like insiders do. 1. The truth no one tells you. Foreign ownership data is not just for show. Many people treat foreign ownership room data like a dry spreadsheet, just numbers. But remember this. Even a slight shift in foreign ownership can be the signal of a massive move. Picture this. A stock has been sold off by foreigners for weeks, then suddenly it's quietly bought over 3 days. Only 0.3% of the room increases seems meaningless. But days later, the stock explodes upward, and you're left chasing at the top. If you only see room data as numbers, you're missing the footprints of smart money. And here's the kicker. You don't need to be a data analyst to spot it. 2. Foreign investors don't buy with emotion like we do. While retail investors often buy on hype and sell on fear, institutional investors, especially foreign funds, follow strategy, structure, and clear long-term goals. When they accumulate, they do it quietly. They don't chase prices or create drama. But if you know how to look, you can spot every step they take. Have you noticed? When markets shake, foreign investors scoop up panic-sold stocks. When the market heats up, they quietly pull out, even if prices still look strong. They buy in small lots across many days, but focus on 1 to 2 stocks with a story. That's not random. That's a money flow map, showing where the market will go next. 3. No expensive software, no paid data. You can still track foreign flows. Here's what surprises most people. You don't need pricey tools or fancy AI. You just need public data, the right perspective, and a little daily attention. I'll show you how to use free room data to track accumulation/distribution. Read subtle changes in ownership percentages. Distinguish between buying due to room increase versus true long-term positioning. And most importantly, spot the quiet footprints of smart money. All of this will be unpacked in the upcoming sections. 4. The reason you always arrive late is your perspective is off. Many investors assume, foreigners are buying, I should jump in too. But be careful. Not every foreign buy means long-term conviction. Sometimes it's a supply test, a temporary accumulation, or a way to lure retail money in before dumping. The real question is, how do you know which buys are real and which are a setup? Once you spot the difference, you'll no longer chase the money. You'll position ahead of it. 5. In the end, it's not about the data, it's about how you feel the money flow. Foreign room data is just a tool. What sets you apart is your intuition for flow, like a true market operator. When you sense how money moves silently, When you understand why stocks drop on good news, when you see foreigners buying the most boring stocks at the most boring times, that's when you're playing the real game. What's next? In the next section, I'll share a set of practical foreign flow tracking formulas built specifically for individual investors. Tiny daily clues left behind by big money. Common accumulation and distribution patterns. And most of all, how to detect real entry signals before the market even reacts. These are insights few talk about, not because they're hiding them, but because they don't even see them. Let's go deeper and look at the market through the lens of real money flow. Part 1. The mystery of foreign room, silent capital with massive impact. In the stock market, there's a language few bother to learn, but those who do gain an extraordinary edge. That is the language of capital flow, especially foreign capital. Today, I'll take you into a world that few retail investors ever truly understand. How to read foreign capital movements through room data, with your own eyes, no fancy software, no advanced techniques. It may sound simple, but this is exactly what gives big funds and institutional investors the ability to stay 2 to 3 steps ahead of the crowd. 1. Foreign room. Why tighter limits mean bigger opportunities. First, you need to understand. Foreign room refers to the maximum percentage of shares that foreign investors are allowed to own in a listed company. Example. A company has a foreign ownership cap of 49%, and foreign investors already hold 47%, meaning there's only 2% room left. That 2%, though it seems small, can shake the entire market. But when the room is nearly full, any foreign transaction can cause massive price movements. And once the room is maxed out, any institution wanting in will do whatever it takes to buy, often paying higher than market price. Remember, room isn't just space, it's pressure and momentum for capital flows. 2. Why foreign investors keep winning while retail still struggles. Have you ever seen names like Fubon ETF, VanEck, VNM ETF, Amersham, Dragon Capital, and wondered, when did they buy in? The stock already surged before the news even hit. That's not luck. That's strategy and extremely refined capital flow analysis. They don't act on emotion. They don't wait for good news to buy. They read the flow. They watch the room. They calculate every move. While most retail investors FOMO in after the price rises, foreign investors have been quietly accumulating for weeks, guided by room data. Then at the perfect moment, news drops and they unload, right when you're most excited. 3. No fancy tools needed, just learn to read the room the right way. Trust me, you don't need a quantitative analysis system to track foreign capital. You only need 3 things. Room data, already freely available on HOSE, HNX, apps like FireAnt, SSI, MBS, etc. Monitor trends. Watch buying/selling patterns daily and weekly. And most importantly, think like an institution, not like a retail trader. In the next section, I'll show you how to spot a real accumulation using room changes. Why sometimes foreign selling doesn't cause a price drop, and what it means. And when to jump in by following the footprints left by big money. 4. The foreign room battlefield, not for those who arrive late. Here's what you must remember. Foreign capital doesn't like crowds. They prefer going in early when others are fearful. If you see room being bought aggressively for 5 straight days, don't jump in just yet. Ask yourself, who's buying? Why this stock while the market is flat? Is there inside info retail investors don't know? And on the flip side, if you see heavy foreign selling over 1 to 2 sessions, don't panic. It might just be rebalancing. But if it's continuous over 10 sessions with low liquidity, that may be a real exit signal. Reading the room isn't just about who's buying, it's about knowing who's quietly leaving the table. 5. Every smart investor learns to read the room, but few talk about it. Because when you don't know, you're the one arriving late. And the latecomer always buys from the early bird at a higher price. In the next part, I'll share with you 3 room movement patterns that often come before major breakouts. A checklist to tell whether rising foreign ownership means real capital or just bait. And most importantly, the golden moment to shake hands with foreign investors without being dumped on. And don't go anywhere, because at the end of this video series, I'll reveal a special strategy called Room Mirror Tactic: How to Detect Institutional Moves 5 Sessions in Advance. Something very few know, and almost no one shares publicly. If you found this valuable, hit subscribe to Bold Steps Forward. Together, we'll learn to read the market like real institutional players. No fluff, just precision, timing, and clarity. Part 2. 3 foreign room patterns that signal a capital flow storm. Spot the wave before it hits. In Part 1, we unveiled how foreign capital quietly leaves traces through room data. But if you think just watching room go up or down is enough, then the market would be way too easy. The key isn't how much the room increases, but how it increases. In this part, I'll reveal 3 room movement patterns that often appear before major price surges, signals that, if you spot early, can help you enter before the wave hits, instead of buying after the news and getting trapped. Pattern 1. Drip accumulation, sudden blast. Characteristics. Foreign room increases slowly over a few sessions, each day up 0.1 to 0.3%. Liquidity is average, nothing abnormal. No major news or catalysts. Then, suddenly in one session, foreign investors buy aggressively, room jumps 1 to 2%. Stock gaps up, volume spikes, followed by a relentless uptrend. Interpretation. This is a classic institutional accumulation pattern. Big players never accumulate everything in one go, too easy to spot. They test the supply by accumulating slowly, then launch a surprise push after clearing out the weak hands. Examples of stocks that followed this pattern? V&M, MWE, during foreign buying frenzies. Pattern 2. Push, dump, push again. Room drops then surges. Characteristics. Foreign room rises slightly for a few sessions, then suddenly drops. Price doesn't fall, sometimes even holds or rises. Within 3 to 5 sessions, the room is refilled quickly, even surpassing the previous level. Interpretation. This is a common noise tactic by institutions creating fake sell signals to scare retail investors into selling. They might sell across internal accounts or transfer holdings, then scoop shares back from panicked retail hands. This strategy helps them increase liquidity, buy back at better prices, shake out weak holders before a real price rally. A clever technical trap, easy to fall into without close observation. Pattern 3. Diverging room, rising price despite net selling. Characteristics. Foreign room gradually decreases, continuous net selling. But the stock price keeps rising or holds steady. At times, domestic investors start buying aggressively while foreign sell. Interpretation. This could be a capital rotation between institutions or foreigners rebalancing portfolios while informed insiders accumulate. Key point. If price doesn't fall when foreigners are selling, it's a sign of strong support and likely accumulation for an upcoming breakout. Room reading checklist. Think like an institution. Use this checklist every time you analyze foreign room. Diagnostic question: what it reveals, watch out for. Is the room rising steadily or suddenly? Steady equals stealth accumulation. Sudden equals wave coming. Sudden jumps could mean a big move is near. Room up with high or low liquidity. High equals aggressive buying. Low equals maybe noise. Room up plus low volume equals watch closely. Room up but price doesn't rise? Likely silent accumulation. Not ready to move yet. Monitor next 2 to 3 sessions for confirmation. Room down but price rises? Technical selling or portfolio adjustment. Don't rush to sell. Check liquidity and domestic action. Next up, so when is the best time to enter? Here's the part most people miss. Knowing that the room is increasing isn't enough. You need to know when to enter so you don't get dumped on by institutions. In the next part, I'll walk you through how to time your entry when foreign room is rising, how to tell apart fake room growth versus real institutional buying, and most importantly, a simple quantitative formula to know when accumulation is complete and a rally is about to start. Don't miss it, because toward the end of the video I'll reveal a powerful technique called the room reflection strategy. Detect institutional moves before they're visible. This strategy has helped me dodge multiple bull traps and ride 2 major rallies ahead of the crowd. If you find this content valuable, share it with your friends and hit follow on Bold Steps Forward so you don't miss the next part. Part 3. When to buy. How to identify fake room increases versus real institutional moves. Have you ever seen foreign ownership room increase? The stock looks solid, the news is great, but the moment you buy, the price tanks? If yes, congratulations, you've just been fooled by a fake room pump. In this section, I'll guide you through how to spot a real room increase with institutional money, when to enter the trade, and a simple formula to measure the heat of foreign inflows. 1. Real room versus fake room. Know the 3 key indicators. Indicator 1. Liquidity must rise proportionally. A real room increase always comes with a rise in volume. Because large institutions can't buy silently. If the room goes up but the volume stays oddly low, that's a red flag for a fake room pump or internal transfers. Real example. July 2022, SSI's room increased by 2% in 5 sessions, each with over 1,000 billion VND in liquidity. Price surged afterward. November 2021. VNM's room increased by 1.5% in 3 sessions but had weak volume. Price stayed flat and then reversed. Bottom line, room up plus strong liquidity equals safer signal. Indicator 2, is price action confirming it? A real room increase leads to clear price behavior. Price doesn't crash right after the room increase. There's a base pattern forming, followed by a light breakout. No weird long wick candles or sudden reversals. On the other hand, if price rises and then immediately gets dumped after the room increase, you're being herded. If price goes sideways and fails to break resistance, the room signal is not yet strong enough. Indicator 3. Are multiple stocks in the same sector moving? If you see room increases across multiple stocks in the same sector, especially in sectors with strong catalysts, like banks, brokers, real estate, that's a powerful sign. That's when you should start paying close attention. 2. When to buy. Use the 3R formula. To simplify timing your entries, here's my personal formula. 3R equals room, range, retest. When all 3 conditions align, your probability of success increases dramatically. Room? Is the room increase meaningful? It's not just about how many percent increased, but how much room is left. If room increases by 2% but there's still 40% left, that's not a strong signal. But if the stock has only 2 to 3% left and institutions are still buying, that's extremely bullish. Range? Is the price range tightening? Before institutions push the price up, they often compress the price range, like a coiled spring. Look for 3 consecutive sessions with less than 2% price range. Volume decreasing, but room still increasing. This signals quiet accumulation, the calm before the breakout. Retest. Was there a successful retest? A breakout without a retest can be a trap. The strong stock will break above resistance. Pull back to test the breakout zone. Hold that level with visible buying pressure. If the room continues to increase during this retest, that's your green light to buy. 3. Sneak peek at a special strategy, coming next. In the next section, I'll reveal a unique strategy one call the mirror room strategy. This strategy not only helps you spot where institutional money is flowing in, but also warns you when it's about to pull out, lets you follow institutional moves without being a pro analyst, works for all account sizes, from total beginners to $20,000 plus portfolios. This is the kind of insight rarely shared publicly because it gets close to how institutions think. If you're a retail investor who wants to go far and last long, you can't afford to miss it. If you found this helpful, comment, want to learn mirror strategy, so I know you're following. Like, subscribe, and share this with others struggling to understand foreign room moves. And stay tuned. The final part will reveal how to combine foreign inflows plus local momentum to create explosive investment breakthroughs. Part 4. Mirror Strategy: How to Follow Institutional Moves Without Being an Expert. Many retail investors often think tracking institutional money flow is only for pros. I'm just a beginner. How can I keep up? Totally wrong. You don't need to be an expert. You just need to understand how to look through the mirror by reflecting the repeating behaviors of institutional money through foreign ownership data. That's the mirror strategy. This strategy helps you detect when institutional money is starting to accumulate. Spot fake teaser moves designed to mislead newbies. Know when institutional money is silently exiting. 1. Mirror strategy. The core lies in 2 words. Repeat behavior. Foreign ownership data is behavior. Repeating behavior equals money trail. Big institutions never act randomly. They have procedures, checklists, and habits. Your job is to look in the rearview mirror, observe how they acted in the recent past, and mirror that behavior with the current moment. Step 1. Choose 3 to 5 stocks that had strong room increases in the past 6 to 12 months. Examples: FPT had 3 major room increases, followed by steady price rises. MWG, room increased, but price dropped sharply, a pump and dump alert. VND, room increased in small batches, price consolidated, then exploded. Record the price patterns, volume, liquidity, and room activity before and after each increase. Step 2. Analyze the repeating behavior. You need to answer: how long do institutions accumulate before pushing the price? How many sessions of room increase before a breakout? Is there a retest? Any specific chart pattern? Example: you notice stock A usually has 3 sessions of room increase, followed by 2 sessions of low volume, then a breakout. If the same pattern appears now, that's your entry signal. 2. How to apply the mirror strategy in real trading. Let's take a real case with VND stock. May 2023, room rose 1.8% over 4 sessions, price moved sideways, low volume, day 5, small breakout, day 6, price explosion. September 2023, room rose 2.2% over 5 sessions, exact same pattern, price surged 18% in 2 weeks. With mirror strategy, you don't have to guess. You just mirror past behavior and act when the conditions match. 3. Negative mirror signals, warning of institutional exit. This strategy doesn't just help you buy at the right time, but also tells you when to stay out. Look out for signals that show institutions are exiting, even when room is increasing on paper. Room rises slowly, price slightly declines, volume shrinks, a sign that pros are handing it off to retail investors. Room increases one day then stops, while sell volume spikes above the 10-day average, silent distribution. Price moves sideways but RSI drops. Buying power is fading. That's your cue to step aside before you get dumped on. 4. Customize mirror strategy for small accounts. You don't need a big account to use this strategy. You just need a list of stocks with low remaining foreign room, a 10-session foreign room chart, an eye for repeating patterns. You can even use basic Excel to build your mirror table. Column 1 stock ticker. Column 2 number of sessions room increased. Column 3 price range volume. Column 4 price behavior after room increase. Column 5 match with past behavior. When 80% of the data aligns, That's a strong signal. 5. Final reveal, the deeper layer of money flow. Combine foreign room plus proprietary trading plus margin volume. In the final part of this video, I'll reveal a powerful combo. Foreign room is just the surface, but when you combine it with proprietary trading and margin volume, you'll see the hidden waves few people notice. This is how you get ahead of the crowd. Enter before money becomes obvious. Exit before the tide turns. This is a strategic layer even many brokers overlook. If you found this part valuable, please comment. I'm ready to enter the deeper layer of money flow. Share this video with your investing community. And don't forget to subscribe to Bold Steps Forward so you don't miss the powerful final episode coming soon. Part 5. Foreign room, proprietary trading, margin. The deeper layers of capital flow no one teaches you. If you've made it this far, you're no longer a naive beginner. You're about to enter a strategic zone that even many brokers and analysts often overlook, not because it's hidden from charts, but because it lies beneath seemingly scattered data. Imagine this. Foreign room is the leading signal. Proprietary trading is the rhythm keeper. Margin is the momentum. When these three align, you won't just spot major capital flows, you'll know when they're about to reverse, a secret almost no one teaches publicly. 1. Foreign room surface layer. The early signal that's not enough. You've already learned how to read foreign room to predict institutional moves. But room alone is not enough. Institutions may finish accumulating, then pause. The room stays flat, but price continues rising. You might think it's still in accumulation. Sometimes the room increases to create a false signal, then proprietary traders sell off or margin gets squeezed, and you're trapped in a fake rally. Room is just the surface. You need to dive deeper. 2. Proprietary trading middle layer, the wave conductor. Proprietary trading teams play the short-term game. They often move early to create waves that retail investors follow. Exit gracefully during peak excitement. How to spot proprietary capital flow. Sudden, strong buying in a specific sector, e.g., securities, banks, steel, creates mini waves. Buying after foreign room increases confirms that real institutional money is flowing. Gradual selling, not abrupt, silent distribution, avoiding panic. What should you do? If room is rising plus proprietary trading buys strongly, high probability it's a real wave. If room is rising but proprietary is net selling 3 to 5 days, red flag. Avoid chasing the top. 3. Margin deepest layer, the invisible pressure. Margin isn't disclosed publicly, but you can smell it through indirect data. Margin is a double-edged sword. When margin money floods in, prices surge. But when it's squeezed, prices crash hard. How to read hidden margin pressure. Volume spikes, but room and proprietary are flat. High chance margin FOMO is entering. Price rises rapidly, but volatility is high. RSI greater than 75, overheating, margin entering at the top. Crucial tactic. Compare liquidity versus price movement. If volume rises but price barely moves, Likely margin money is entering while institutions are quietly exiting. Equals, be cautious. Don't be the one holding the hot coal at the end. 4. How to combine all 3 layers for perfect timing. Imagine you're analyzing stock XY. Foreign room increased for 3 straight days. Proprietary trading starts light buying. Volume rises, but price only ticks up slightly. Forecast. Institutions are accumulating, prop traders are probing, margin hasn't entered yet. A good time to test the water, not to go all in. 5 days later, proprietary trading ramps up. Volume explodes. Price breaks out strongly. Room stops increasing. It's wave time. You can deploy significant capital. 10 days later, room stalls. Proprietary begins mild selling. Volume up, but price flattened. Margin is holding the wave. Red alert. Near the top, time to start exiting. 5. Real-world strategy. All you need is a Google Sheet. You can track everything with a simple table like this. Date stock foreign room prop trade, net, volume price evaluation. 12/5 XYZ plus 0.5% plus 20B 80B 25.5 institutional buy. 13/5 XYZ plus 0.7% plus 30B 90B 25.9 entering wave. 15/5 XYZ 0% dash 15B 100B 26.2 prepare to exit. Just 5 minutes a day and you'll stop chasing rumors. Stop panicking during shakeouts. And most importantly, have a plan before the capital moves. End of series. You now have the tools to follow smart money. If you've followed this far, I believe you're no longer an investor driven by emotion. You've learned how to read the foreign room as an early signal. Follow proprietary trading as the wave keeper. Sense margin as the emotional current of the market. This is the kind of knowledge no basic investing course will ever teach you. Call to action. Don't get lost in the big waves. If you found this video series valuable, share it with F0 investors still lost in rumors. Comment, I'm ready to track smart money, so I know you're stepping up to the next level. Subscribe to Bold Steps Forward, because next up is a powerful new series, Smart Money, the hidden traps retail investors never see. You don't need to be a genius. You just need to face the right direction. And smart money always leaves a trace for those who can read it. Bold steps forward, steady steps with smart capital.